10.1, you have Parker and Stone Company bought land for a new manufacturing plant 6 years ago for $3.5 million. Never built, so it's a sunk cost. We're going to ignore that. If the land were sold today, it would net $3.9 million, so that's an opportunity cost. The company now wants to build a new manufacturing plant costing $16.7 million today plus $850,000 of grading. What's proper relevant cash flow in this problem? Again, we want to do this on a standalone basis. The relevant cash flows are the plant cost plus the grading plus the opportunity cost that we're giving up by not selling the land. We want to ignore sunk cost of land, the original cost many years ago for $3.5 million. So the relevant cash flow total cost for this project would be the plant cost of $16,700,000, the grading cost of $850,000, and the opportunity cost of $3.9 million if we were to sell the land. Total cost $21,450,000. There's your answer to problem 10.1. In problem 10.2, we're given that Winnebago sells 30,000 motorhomes per year currently at $73,000 each, and 14,000 luxury coaches at $120,000 each. On a new project, they want to sell 25,000 new portable campers per year at $19,000 each. This will boost sales of your motorhomes by 2,700 per year, decrease the luxury sales by 1,300 units. What's the proper sales figure for this project? Now, the temptation is to take the old sales and add them to the new sales, and subtract out the old sales. Don't do it. Don't avoid that temptation. Just do it on a standalone basis. Take the Delta motorhomes minus the Delta luxury coaches plus the new portable campers. Keep it simple and do it on a standalone basis. So our incremental sales are 2,700 motor coaches at $73,000 each, $197.1 million. I'm going to subtract the 1,300 luxury coach decrease at $120,000 each. So that's a negative $156 million impact. And then my 25,000 new portable campers at $19,000 each, that will generate $475 million in new sales. My total incremental sales to use for this project, $516,100,000. There's your answer to problem number 2. In problem 10.3, this new project has sales of $635,000, variable cost of 44% of sales, fixed cost of $193,000, depreciation of $54,000, and a tax rate of 35%. What is the net profit after tax? What we're looking for, otherwise known as net income. Sales minus cost equals net income, as we know from chapter 2, also known as NPAT, net profit after tax. So I create a vertical income statement. I stop when I come to swoosh swoosh. Don't stop till you get swoosh swoosh. Sales of $635,000. Variable cost of 44% of sales, or $279,400. Fixed cost of $193,000 was given. Depreciation $54,000. From, if I take those numbers away from my sales, I get an EBIT of $108,600. I take 35% of that to get tax of $38,010. I'm going to subtract that to get my net income of $70,590 on my P&L. Profit and loss statement, also known as an income statement. There are your answers to problem 10.3. In problem 10.4, we're given sales of $713,500, cost of $497,300, depreciation of $87,400, tax rate of 34%. Looks very much like a P&L to me. Author wants to know what's the NPAT or net income, what's my OCF or operating cash flow, and what is my depreciation tax shield, DTS. Equations. The income statement equation, sales minus cost equals net income. The OCF equations, traditional EBIT plus D minus T. As we'll learn in chapter 11, if there is no interest expense, we can use bottom up, top down, or tax shield approach also, but we'll go traditional, it's always safe. And depreciation tax shield is D times T, or depreciation dollars times tax rate. So I lay out my P&L vertically. I stop when I get to swoosh swoosh. $713,000 of sales, $497,300 of cost. Depreciation is $87,400. That leaves me with an EBIT, earnings before interest and taxes, of $128,800. I take 34% of that, and I get $43,792 in taxes for a net income of $85,008. Is my NPAT, or net income. Then I want to calculate my OCF. The OCF calculation is EBIT plus D minus T. So EBIT is right here, 128.8. I bring over my depreciation. I add it back because it's a non-cash expense. And I'm looking for cash. I'm looking for OCF, operating cash flow. So since I took it out, I must add it back, 87,400. And tax will be a cash item, so 43,792. I get an OCF of 172,408. And I can test that by taking my NPAT plus D, since there's no interest expense in the calculation, and I should get the same answer, 172,408, and it looks like I do. And my depreciation tax yield is depreciation of 87,400 times my tax rate of 34%, and I'm shielded by taxes to the tune of 29,716. 29,716 is my depreciation tax shield. Remember, two things about depreciation: is a non-cash expense, I must add it back, and it is a very effective tax shield. Two things you want to remember about depreciation. There are your answers to problem number 4. In problem 10.5, we have sales of 164,000, cost of 87,000, depreciation of $15,200, and a tax rate of 35%. What is the net income? What is the OCF? Use all 4 methods if there is no interest expense in your P&L or income statement. So my equations are sales minus cost equals net income. When I see the letters OCF, I must calculate an income statement, because all the components of the OCF come off the income statement. So I must do a vertical income statement, stop when I get to swoosh swoosh. Your boss might call it a P&L. Same thing. OCF, 4 methods equals EBIT plus D minus T. That's traditional, it's always safe. Bottom-up method, NPAT plus D, and so on. There are 4 methods mentioned in the book. We'll go through all 4 of them. We should come up with the same OCF, hopefully, if we do our work right. So I take my sales of 164,000, subtract cost of 87,000, subtract depreciation of 15,200. That leaves me with EBIT of $61,800. I subtract taxes at 35% of 21,630, and I get an net income of 40,170 NPAT. Now I'll use the traditional method, always safe, whether there's interest expense in the income statement or not. EBIT of 61.8 plus depreciation, add it back of 15,200, subtract out your taxes, and I get of 21,630, and I get an OCF of 55,370. There's your operating cash flow. Now to check that using bottom-up method, if there's no interest expense, I can use bottom-up. 40,170 of net income plus 15,200 of depreciation, add it back. I get an OCF of 55,370, and that's what I should get. Ties into traditional approach. Top-down approach, also, if there's no interest expense in the income statement, 164,000 of sales, 87,000 of cost, 21,630 of taxes, and I should get the same OCF of 55,370. And I can also use the tax shield approach method 4 if there's no interest expense. I take my sales minus cost, so 164,000 minus 87,000, and I multiply that by 1 minus tax rate. So it's the after-tax effect of sales minus cost. I get $50,050 for that answer. I add that to my tax shield, which is D times T, depreciation of 15,200 times tax rate of 35%, which gives me 5320. I add those 2 pieces together and I get an OCF of 55,370. And there are your answers to problem number 5. In problem 10.6, we have equipment costing $1.24 million today, brand new. We're going to use 7-year MACRS, Modified Accelerated Cost Recovery System depreciation. Calculate the depreciation amounts each year and the ending net book value. So our equations are equipment cost times MACRS percent will give me the depreciation amount. Each year, and then my ending book value is simply the beginning book value minus that annual depreciation amount. So I get the depreciation percentages from the book, from the Internal Revenue Service. They provide these. Notice that for a 7-year MACRS, it goes 8 years. Notice I get some goodness in year 2 and goodness in year 8. If this were straight line, it'd be 0.1429 each year, same amount each year. But since it's not, we get a higher amount in year 2 and some in year 8. We're in straight line, it'd be straight line 7 years and done. A couple of checks here. Your percentages should add up to 100%. Your depreciation should add up to the original cost of the equipment, 1.24 million, or you've done something wrong. And your ending book value should zigzag down to 0. So 3 checkpoints on these. Make sure your percentages are correct. Make sure your depreciation adds up to cost of equipment. And make sure your ending book value zigzags down to 0. So solve this problem. I take the cost of the equipment times 0.1429, and I get 177,196. I take the cost of the equipment times 0.2449, and I get 303,676. I take the cost of equipment times 0.1749, and I get 216,876, and so on. I calculate all my depreciations, add them up, and I should get to 1.24 million, $1,240,000. Then to calculate the ending book value, I take the original book value and I subtract the first depreciation, and I get 106,280,4. I take that ending book value minus 303,676, and I get 759,128. 759,128 minus the next year equals 542, and so on all the way down the column. And I should end up with in year 8 with a 0 net ending book value. Someone might ask you what's ending book value end of year 4. The answer to that would be 376. If someone ever asked you what it would be, or if you're going to sell the equipment in that year for more or less than that amount, you'd have a gain if you sold it for more, and you'd have a loss if you sold it for less than what you had on the books. There's your answers to problem 10.6. In problem 10.7, we have an asset costing $730,000, depreciated straight line to 0 over 8 years. The asset we used in a 5-year project and will be sold $492,000 at the end of year 5. Tax rate is 40%. What is the after-tax cash flow? So a couple of equations. The basic annual depreciation is calculated by taking the asset cost divided by 8, so we're going to get about $91,250 of depreciation every year. And the salvage value is the selling price of $192,000 plus any tax savings we're going to get if we sell this piece of equipment at a loss. So we build our depreciation table, we build our annual depreciation. Summation of these should add up to the cost of the equipment, which is $730,000. So that's one check we can make. The depreciation percentages should add up to 100% fully depreciated. And then the ending book value should wind down to 0, so it should zigzag down. So I'll take 730,000 minus the first 91,250 should give me 638,750 minus 91,250, and so on down the line. And by the end of the 8th year, I should get to 0 ending book value. However, we want to look at this at the end of year 5. So right here, we're going to take a look at this, what's on the books, and then what are we selling this piece of equipment for. On the books, we're left with $273,750. We sold it for $192,000, so that means we took a loss of $81,750. The IRS, Uncle Sam, will give us tax credit for that, some tax savings at 40%, so my tax savings will be $32,700. That'll be coming in addition to the selling price of $192,000 plus the $32,700. So my after-tax salvage value is $224,700. $224,700 is your answer to problem number 7. In problem 10.8, we have an asset costing $6.5 million. We're going to sell it for $1.6 million into 4 years. We're using this asset in a 5-year project, which means in MACRS terms it goes down to 0 over 6 years. And we get a little bit of a bonus in depreciation in year 2 and in year 6 over straight line, which would just be 2020, 2020, 20 over 5 years. So we get a 6th year and we get a big boost in the 2nd year. We're going to sell this for $1.6 million at the end of 4 years. Now, will that be at a gain or a loss? We'll figure that out. And then the tax rate's 35%. What's the after-tax cash flow or after-tax salvage value? So again, I list my MACRS percentages. Modified accelerated cost recovery system, 20%, 32%, 19.2%, and so on. All these percentages should add up to 100%. I put them in decimals for multiplication's sake. My depreciation dollars is just 20% times the cost of the asset, 6.5 million. 32% times the cost of the asset equals 208,000, and so on. All of these depreciation dollars should add up to the cost of the asset. 6.5 million, that's another good check to make sure that you're doing things correctly. And then when I zigzag down, take the cost of the equipment, take out the first depreciation, that gives me 5.2 million minus 208,000 should give me 3,120, and so on, all the way down, zigzag down. I should get an ending book value of 0 at the very bottom. So another check, 3 different checks on these MACRS problems. We want to know what happens if I sell this piece of equipment at the end of year 4 for $1.6 million. What's after-tax salvage value? So the selling price is $1.6 million. The ending book value is right here at the end of year 4, 1,123,200. So I have a gain on this sale of $476,800. Tax stat at 35%. Whenever I make a gain in life, Uncle Sam would like some tax. So I pay 35% of that gain, or $166,880. Now my after-tax salvage value or after-tax cash flow is the selling price of $1.6 million, less this tax of $166,880. I get an after-tax cash flow or after-tax salvage value of $1,433,120. There's your answer to problem 10.8. In problem 10.9, we're given that Quad Enterprises has a 3-year expansion project in the works with initial fixed asset investment of property, plant, and equipment of $2.9 million. We're going to depreciate this equipment straight line to 0 over 3 years, so 3-year project, as I said. It generates $2.19 million in sales each year, cost of $815,000 each and every year. Tax rate's 35%. What's the OCF on this project? So 2 equations. Whenever I see the letters OCF, I must build an income statement. Sales minus cost equals net income. And OCF traditionally is EBIT plus D minus T. We'll teach you some other ways to calculate that, but for now we're going to use traditional method. So I build my P&L, my income statement. P&L stands for profit and loss. Sales of $2.19 million, cost of $815,000. Depreciation is the cost of the equipment, $2.9 million divided by 3. To get that depreciation number. My EBIT's $408,333 by subtraction. Taxes are 35%, $142,917, and my net income is $265,417. If I did the math correctly, if you've done the math correctly. Then I need my OCF calculator. EBIT plus D minus T, 408,333, which I get from the P&L. Depreciation, which I get right from the P&L, 966,667. I add that back because depreciation is a non-cash expense and I'm looking for cash, operating cash flow. So I took it out to get EBIT, I must add it back to get cash, or operating cash flow. Plus 966,667 minus taxes, which is a cash expense of 142,917. Plug that in. My OCF calculation, I get an OCF of 1,232,083, and I'm going to have that each year for 3 years. 1,232,083 for 3 years will be coming in with this project. There's your answer to problem 10.9. In problem number 10, we have given that Quad Enterprises is considering a 3-year expansion with an initial fixed asset investment of $2.9 million. Depreciate straight line 0 over 3 years, generates $2.19 million in sales, $815,000 in cost each year, tax rate 35%. So the same givens as last time. We calculated the OCF in the problem number 9 to be 1,232,083, and we're going to get that in for 3 years. Now, if the required return on this company is 12%, what's the net present value of this project? So, same answer as problem 9, but now we're going to calculate the NPV. NPV is minus the cash outflows, plus the discounted cash inflows, discounted at 12%. So we set up a little cash flow table trying to calculate free cash flow, or CFFA. We know that CFFA is OCF minus NCS minus CNWC. So I set up my little table here, my cash flows from problem number 9. 123208333, 123208333, 123208333. We get that in for 3 years since it's a 3-year project. Today this project costs $2.9 million. What's the net present value? So I lay out the cash flows and then I discount the cash flows. Well, this initial cost today is not discounted at all, but the other 3 cash flows will be discounted. We're going to divide this by 1.12, the second year cash flow by 1.12 squared. So we'll take this first one by 1.12, second one divided by 1.12 squared, and the third one divided by 1.12 cubed. And we'll get these resultant discounted cash flows. 110007440 in year 1, 982200929 in year 2, and 876972258 in year 3. Those are my discounted cash flows. I'm going to add them up. My discounted cash inflows, compare them to today's cash outflow of negative 2.9 million. We'll put brackets around that to make it clear. And I get an NPV of 59,256.28. 59,256.28. And there's your answer to problem number 10. In problem number 11, we have the same givens as 9 and 10, except this time we're going to insert some working capital to start the project off of $300,000, and that's a cash outflow for cash, accounts receivable, inventory, and so on. I can sell my equipment at the end of the 3 years for $210,000. Now, what's the NPV? So similar answers, similar cash flows that we had in the last 2 problems. However, this time we're going to interject some working capital in times 0, which I'm going to get back in year 3. So minus 300,000 plus 300,000. And instead of the piece of equipment just winding down to 0, it does wind down to 0, but now we're going to sell for $210,000. So we're going to get some salvage value. Now the question is, do we put $210,000 in here, or is it going to be less than that? Well, we get $210,000 cash for the equipment, but we must pay a tax on that because it's been depreciated down to 0. We straight lined it to 0 over 3 years. It's worth nothing on our books. It's worth $210,000 in cash at the end of 3 years. So I have to pay some tax on that at the to the tune of 35%. So 35% of 210,000 is 73,500. So my after-tax salvage value that I'm going to insert into our cash flows is 136,500, not 210,000. Then I compute my cash flows again each year just by adding these up. 2.9 million out plus 300,000 working capital is 3.2 million. Then I get my 3 cash flows, 1, 2, 3, 2, 083, 33 each of the 3 years. I must insert my salvage value, after-tax salvage value of the equipment, 136.5, and then I return my working capital to my company by selling off all my accounts receivable and selling all my inventory, and collecting my accounts receivable. Sell off all my inventory, collect accounts receivable by knocking on doors, and get that cash flow coming back. And very optimistically, but nevertheless, we're going to estimate it at the full 300 grand. And then calculate the cash flows. 2.9 million out plus 300,000 out is 3.2 million out today. The 1232083, 1232083, and then add up these 3 numbers to get 1668583.33, and then undiscounted dollars, and I need to discount these at 12%. So 3.2 million today is 3.2 million out today. My first cash flow I divide by 1.12 to get 110007440. Just like in the last problem, I divide my second cash flow by 1.12 squared. I get 982200929, and my third cash flow I divide by 1.12 cubed to get 118766466. Add all these discounted cash inflows to my cash outflow, and I get an NPV of $69,948.35. And there are your answers to problem number 11. In problem number 12, we're going to make this a challenge problem. It's very challenging. This time, same as the last several problems, but in this case we're doing MACRS. Depreciations. Everything else is the same, except now it's MACRS depreciation. 3-year depreciation, so we know that MACRS table goes for 4 years, so my depreciation values change. And I have to create several new profit and loss statements. Sales are still the same at $21.90 each year, $815,000 of cost, and now my depreciation number is now MACRS percent. I get 966,570, 128,9050, and 429,490 after 3 years. But there's still some depreciation left over in the fourth year. This is what's the depreciation is in over 3, and in the fourth year we still have 214,890 left. So we have to take that into account when we sell it. We calculate our net income: 265,479.50, 55,867.50, and 614,581.50, and that's pretty much where I'm going to stop. The challenge is for you to calculate these boxes. From this P&L, calculate OCF1, EBIT plus D minus T. Fill that in here. Calculate OCF2 by taking EBIT plus D minus T for year 2, and fill that in here. And then come to the third income statement, take EBIT plus D minus T, and fill that in here for OCF3. My 300,000 of net working capital stays the same, 300,000 out. 300,000 in as in the past 2 problems. But now my after-tax salvage value is going to change. I'm selling the equipment for 210,000, still on the books. I have 214,890 of depreciation left, so I'm selling this equipment at a loss. So this after-tax salvage value number will be the 210,000 plus the tax savings that I'm going to get by selling this at a loss of $4,890. And then fill in your annual OCFs. Once you fill in these boxes, discount those at 12%, and then come up with an NPV. There's your answers to challenge problem number 12.